Hello and welcome to another episode of the Investing with IBD podcast. It's Justin Nielsen here, and it is July 3rd, 2024. We're taping this a little bit early. We just had a market close on a half day. It's a little bit unusual. So we've got the 4th of July holiday tomorrow. So we're going to be dropping this for all of you to watch, and hopefully you're all having a great vacation day. Of course, the market is going to be back in full swing on Friday with a full day. But in order to kind of get you in the right frame of mind after your holiday, we've got Mike Webster back with us, senior market strategist at IBD, former portfolio manager for William O'Neill and O'Neill Global Advisors for, what was that, 20 some odd years, a couple decades. So
you're trying to make me look and sound old. Is that what you're doing?
Hey, I'm just giving facts. I'm
only 24 years old, buddy, okay. So I don't know what you're talking about.
We'll go with that. So, hey, we've got a lot to talk about. I mean, there's been a real interesting thing in terms of, how the market's been shaping up. We had a downside reversal not too long ago, and here we are right back at high. So one of the things that we're going to tackle today is downside reversals, what those mean and how you should be kind of viewing those, and when it's time to kind of take off the defenses and start going offensive again. But first, before we get into that, let's pull up the market and kind of chat a little bit about what we're seeing. This is a market search chart. We are looking at the NASDAQ composite, and we got that downside reversal kind of right at the 18,000 level. It came right there, got turned away, but didn't really come down much, a little bit more weakness. And then here we are right back up above 18,000. Now, this isn't the first downside reversal that we've had recently, but what is your take on the action right now?
I would look at this reaction that we've had the last 3 days as really the last 2 days as a positive expectation breaker. And we've talked about negative expectation breakers and positive ones in the past before. And it's basically when the market sets up a certain way, giving you an expectation of to either be positive or negative, and then the opposite happens, you really need to pay attention because the market is telling you something. So with that downside reversal, and we're going to talk a lot about that in the next segment and some during this segment, your expectation is a move lower. A lot of times you will come down to at least the 21-day moving average, which is the green line. I was actually expecting to undercut that and get, somewhere in between there and your 50-day. And that would have been normal and healthy. You always want to know what's normal in the market based on whether the news events, how the market's handling itself, the time of year, and so on. And so that would have been normal and natural. But immediately following the downside reversal, we had an upside reversal, which is interesting. But we weren't out of the woods at that point. But then yesterday, we got stronger and stronger throughout the day. It was just building, and it felt like we were just a magnet to take out the downside reversal highs. So any hedges that you would have put on, hedges that I put on, ones that we both put on Swing Trader, we had to remove them at that point because the market was giving you the feedback that, hey, it doesn't want to go down. And so you don't fight the trend. The trend is still up. We're still in a power trend, something that we've talked about numerous times on this podcast with you and Arusha. And of course, that's something that we came up with when the three of us did the chart school, a decade or so ago. And so we're in that market school. Yeah. Sorry about that. So this is a very powerful time for an uptrend, and you want to treat it accordingly. But it doesn't mean you just have the gas pedal down the entire time. When you have things like the downside reversal, you do need to tap on the brakes, take your foot off the accelerator. But then when it does something like this, you take that brake off, you put the accelerator back down, because you need to listen to the market and always be fluid.
Yeah. Now, something to kind of consider here. I'm just going to pull up the cues, to kind of get a sense of what things were looking like here. But let's also look at QQEW, because it's been a little bit, between QQEW, RSP, these have been a lot weaker. So it seemed like the mega cap companies were really kind of putting things a little bit more, making the indexes maybe look a little bit better than maybe everyone's portfolio was looking. What do you think?
Yeah. So I'm surprised that the strength hasn't broadened out besides the mega caps, which is kind of, why the QQEW and RSP, or, even like an IWM or an MDY, the smalls and mid caps, they're just not participating. They haven't been. And a lot of people are kind of sidelined, saying, they're going to wait for the breath to get better before they really get heavily involved. And I think that's a bit of a mistake. You go with the market that you have, and the market that we have, whether we like it or not, is favorable to the mega caps. So why don't you pull up like the FNGS or the FNGU, which are the 10 of the mega caps, and that's where the money is flowing. And you can see that after that downside reversal, the very next day, the mega caps were able to take that out. So this is really your leader, your mega cap tech stocks for the most part. And so that's where the pond you want to fish in until the other ones start perking up. So would I feel more comfortable if RSP and QQEW and IWM start participating? Yes, I absolutely would. But we don't need that, and you don't want to fight it. And, it's kind of, decades ago, before we were born, you had like the Nifty 50 stocks that were kind of driving the market, even when the rest of the market wasn't, participating as much. So I think we're kind of in that, but it's not the Nifty 50. It's just these, you can call them the FANG, you can call them the Mag 7. I just refer to them as the mega caps, because that's where you can think through of why. And I think the reason why is probably the liquidity, the big funds, the big hedge funds, the big mutual funds. Those folks want to be in things that they can get in and out of. Not, you're not going to get blamed if you buy Apple and it doesn't work out. You are going to get blamed if you buy some small cap and it blows up on you. So there's kind of safety in going there. There's also that closet indexing effect that is real. So everyone, you kind of have to buy those if you want to participate. So it's just building on itself. Will it end? Of course. Could end tomorrow. Could end 3 years from now. We don't predict that. We just want to ride this wave as long as we can, as Tom Basso says.
Yeah. So, well, one of the things that is maybe an influence here, let's just real quickly take a look at the 10-year Treasury yield. It did have kind of a little bit of a jump here recently, back above the 50-day moving average line. And that does tend to hurt the small cap, mid cap names a little bit more, because those are kind of the upstarts, the ones that are maybe a little bit more sensitive to higher interest rates because of borrowing costs and everything like that. Whereas the mega caps, I mean, they've got so much cash flow now. They're lending money. They don't need to borrow as much, right?
They have deep pockets. And, I think the whole COVID thing really helped the bigger companies versus the smaller companies, just how that played out without getting into all the nitty gritty of that. I think that helped, as well as this interest rate environment. If you've got a bunch of cash, rather than having to leverage, and rack up a lot of new debt, as some of these smaller companies are having to do, that is a big deal.
Yeah. So, you know what? I want to kind of revisit some history here. We've been talking a little bit about this whole idea of, precedents, and we've been using the 2003 and 2009 precedent, to kind of use as an example of what's possible here. And we can pull this chart up. We've been using this a little bit, and just to orient folks on what you're looking at here, this orange straight line here is basically where the follow through day was. So for the most recent, for this rally, we're using the November 1st, 2023 follow through day. Back in 2003, which is the orange line here, we're orienting that to March 17th, 2003. And then for the 2009 rally, we're orienting it to the March 12th, 2009. So what was interesting is we were really kind of looking at this, both, all of these had big, strong thrusts early in the moves, and that's very typical, especially when you're coming from a bear market. And 2022 was brutal. And what they all did was they kind of had these pullbacks. So this was kind of expected. This came down more recently a little bit faster. And we were kind of talking about this breaking the precedent because of how quickly it was coming down, but then snapped right back. And we're like, oh, maybe this is still okay. What do you think of this now?
Well, as we were talking before the show, it feels like it's starting to break with those precedents, but in a good way. So there's a couple angles to look at it. Is we're either closer to that end point, like with the orange, the 03, 04 time frame, that last little gasp before it had an intermediate correction. We've either, fast forwarded through these pullbacks that those had, which on this chart doesn't look like much, but they're like 6% or more, all those little pullbacks along the way. And 6% is a big deal. Like, it doesn't sound like a big deal, but if you're, on margin and growth stocks, a 6% pullback in the average you're going to feel that, and you're going to have to take action, get off margin and such. That hasn't happened. So with a precedent, you always need to know when to throw it out. And as you said, we threw this out back when we broke down to that 8% pullback because of how it did it. And we've talked a lot about that, so we don't need to regurgitate that. But then we said, you know what? It's back on track because it recovered. That percent loss was pretty much right in line with the 8.1 and the 7.6. I mean, you can't get closer than that. But now that we are not having those pullbacks, which we were expecting if these precedents held, now it's, you've got to get ready to kind of throw these precedents out and start looking for new ones. So I'm right there. I'm not ready to completely throw them out, but I'm on the fence there. And if we continue higher without a 5 to 6 or greater pullback in the very near future, like the next week or two, I think we have to just say goodbye to 03 and 09 and find something new. You don't always find a precedent, though.
And do you think that, I mean, in some ways, we've talked about how things feel like they move faster now than they did a couple decades ago. Even 2009. I mean, that's over a decade past now. Is it just everything getting scrunched?
I think there is something to that. There's also something unique to this market where the mega caps, as we talked about, are really driving everything. And so it's that action that is driving the entire market. So you never want to say it's different this time, because that's like your famous last word. So I don't believe in ever saying that. But this is unique, right? Because of all the concentration there. So when they do eventually roll over, which they will, they always do, Bill would say when they raid the house, they get everyone, or he had all those, you remember all the sayings that he would say, there's no sacred cows, what have you, that eventually we're going to go into an intermediate correction. Eventually we'll go into another bear market. That can always happen tomorrow. Like, you always have to have that in the back of your mind, that can happen at any point. Never get too comfortable. But right now, the mega caps all look strong, at this point. Some of them stronger than others. And until they start falling one by one or all at the same time, you've got to have that gas pedal down.
So speaking of which, let's take a look at some of the indicators that you typically like to use. I know that you're a big fan of regression lines, a big fan of your own indicators that you create, specifically the Webby RSI. And just to be clear, it's not the relative strength indicator. It's the real simple indicator. So what are we looking at here?
Okay. So
and again, just for folks, just to know, if you're listening to this on audio, we are, kind of getting a little bit chart heavy here. You can always take a look at the video, investors.com/podcast. So you can kind of get a sense of, I mean, we love charts, so it's hard for us to not use charts when we're talking, but go ahead, Webby.
Yeah, so I'll just walk through. This is something that Allie and I talk about every Friday on the SMT video that we do shortly after the close. So anyone who watches that regularly will know this. But assuming you haven't, I'm going to walk through this. This is the S&P 500 using SPY, the ETF, and I've just put a regression line on there. A regression line is just a line of best fit through a data set. So we're starting that off on at the bottom here on April 22nd, and we're going out 50 days, which was through yesterday. And those are our two anchor points if you're using that in your software program. I'm going to blow this up a little bit more, maybe not that much. So that's the white line. That's your line of best fit. And then you just have standard deviations away from that as kind of your guardrails. So on this one, we're using 3/4 standard deviation. So a 0.75 is your first line, and one full standard deviation away is the other line. So the red on the top and green on the bottom. In the thought process here, and I use the high plus the low divided by 2, just another way of saying the average of the bars. There's different ways of calculating. That's how I like to do it. And so what is this mess that we're looking at? It's a way of knowing the trend and what is normal and what's abnormal. As long as we stay within this area, we're in this normal trend, and we're no longer going to change our anchor points. We're out 50 days now, so we're just going to keep these on there until it either breaks through on the upside or it breaks down below and can't recover. So if we come in near the green area, that's where you want to, as it's coming in, you want to start becoming defensive. But if you see some strength from there, like we had over here on May 31st, as you're coming down, you're defensive. But if the market proves that it can accelerate back up, then your assumption is you're going to do a mean reversion. You're going to go back up to your white line or beyond. And that's what happened here. This was kind of classic. It came into your regression, then it bounced up, went straight up to the white line, your regression line, and just hugged it until it was ready to break, deviate from that, go back above it, and went below it. So now we're right back at this line here. So that is your expectation. Can this last forever? Of course it can't. But it can last longer than you think? Yes, it can. If you study history, trends can last longer than anyone ever thinks. So you just want to ride that trend until it ends. If you start getting up near the red area, that's when it's getting too hot and you need to start taking your foot off the accelerator, start tapping the brakes. When that happens, doesn't mean you go to cash because you don't want to lose your positions, but you want to be selling offensively. If it starts coming back down here, you don't just assume you're going to bounce. You actually wait for that strength after your pullback. Something Brian Shannon talks about: don't buy the dip, buy the strength after the dip. That's something the way I've always operated since the 90s. So if this were to come down in here, wait for some strength, and then add to it as it's going up. We thought we were going to come down into here. It didn't happen. So you started gassing it again yesterday and then adding more today. Let's just look at the NASDAQ real quick because it's the same thing essentially, just a little bit stronger, using the same dates, the same 0.75 standard deviation and the one full standard deviation on both sides. So it's just a little bit higher than the regression. Feels like it wants to get up to around here. I think that would be normal. Again, you're never predicting, you're just interpreting and saying what would be normal. And these are nice guide rails to have to know when things change.
Yeah. And that was about 18,500 where you were kind of saying it could get up to around there.
Yes.
And, right now we closed at, just above 18,000. So a decent move. Now you talked about kind of where it would start looking extended. You also use your Webby RSI indicator to kind of give you a sense of when something looks extended. So explain that a little bit.
Yeah, let me bring that one up just a second. I'm going to stop sharing this and I'm going to bring that up. It'll take me 1 second because I'm not as fast as you are, Justin. So this is again SPY, and the Webby RSI is down here, and I'm just going to expand this a bit so you can see it a little bit better. And it's the histogram that is measuring the distance from the low of the index or stock versus the 21-day exponential moving average. Is something I developed, over the years. And the way I measure this is in ATRs, and ATR is just your average true range. All that means is how much does it normally move on any given day. So
and are you using a 21-day ATR average?
Yes, I am. I'm using a 21-day ATR for that. So when you see this over here where it says 1, that's just saying that it is one standard or one ATR away from your 21-day exponential. Right now for SPY, your average true range for 21 days is 0.89, so it's less than 1%. So it's saying, it's just measuring in those terms. I've found from my research that your sweet spot is really 0.5%, so down here, up to about 2%, or not 2, half an ATR to 2 ATRs is
Right.
kind of that sweet trending area. Once you start getting above 2 ATRs, then it's getting a little bit hot, kind of like with the regression lines where you're starting to sell offensively and you're starting to look for the
You're in
exit.
abnormal territory, right?
That's a good way of putting it. It can get a lot stronger. We saw that over here in the February timeframe. So it's not like you sell everything, but you're just less likely to slam on that gas pedal. And so again, this is the Webby RSI on SPY. Let's look at it on NASDAQ. And this one is a little bit hotter there. So it's up at 2, but this one tends to run a little bit hotter in this market. You can see that, for this, about a week, it got over 2 until it almost got to 3. Once you get to 3, that's pretty hot and you want to start being careful. And so this is a tool that, I'll just unzoom and you can see that it tends to run into that wall around, 2.75 ATRs. And for this one, it's more volatile than SPY. Its current ATR is 1.24%. So that's your average move from your high to your low. That you also look at your prior day's close in case there's a gap.
So 2 ATRs is going to be a bigger move. And as you said, it's more likely with the NASDAQ. And look, another thing that we are going to be talking about in our next segment is sometimes what you'll get is as you get extended, sometimes you get those downside reversals. So when we come back, we're going to talk about downside reversals and why it's a good indicator to pay attention to. Stay tuned. We'll be right back. Welcome back. It's the Investing with IBD podcast. It's Justin Nielsen here, and Arusha is on vacation for a little bit, or actually he might be working, but he's not going to be with us for a few weeks, but that's okay. We've got Mike Webster, also known as Webby. He's here to talk a little bit about downside reversals. And so let's go ahead and we're going to go back and just kind of to get this idea in your head of what a downside reversal is. Again, Friday was a pretty classic example. And what you typically see, Mike mentioned that for market school, Charles Harris, Mike Webster, and we were kind of trying to tackle a lot of different indicators to kind of help us gauge how invested we should be in the market. Not a all or nothing type thing, but a more gradual approach to it. And so we were looking at different indicators that would say, oh, okay, this is a time to kind of scale back a little bit. And one of the things that we all kind of believed in is, hey, when you are getting, you're into new high ground, and we used a 13-week high as an example. So you've been running and then you're making progress. So your high is higher than the previous day. You're getting into new high ground, but then you can't hold it. And a lot of times these downside reversals will have larger spreads. They'll kind of stick out. It's not like a tight day, because tight days sometimes, when you lose a lot of ground, it's like, well, you're not losing that much, it's tight. But when you lose a lot of ground off your high, you close at the bottom of the range. And we actually put in there that you had to close down for the day. These all kind of culminate into what looks like a downside reversal, and the expectation is that you're going to get more weakness. So anything to add to that, Mike, in terms of what we kind of came up with on the data?
No, great job.
Yeah. So the trick is, and I'll be honest, this is where we struggled. Sometimes there's these elements of it when you see it, but Excel. I was doing a lot of this testing in Excel, and with Excel, you kind of have to give a number, right? And so sometimes we were not pleased with the number that we came up with because, in these cases, yeah, that does look like it. In these cases, that didn't look like it. And there's all sorts of things. Well, do you change based on the volatility of the time? Because there's some very volatile times, 98, 99, 2000. Man, the spreads were a lot larger. If you,
I remember that like it was yesterday, man. It was a wild time.
If you weren't moving 1%, it was a quiet day. If you
weren't moving 2%, it was quiet.
Yeah, right. So you have to kind of make those adjustments for and the chart. Our charts usually do make those adjustments for you. But when you're in Excel, it's kind of like the numbers are the numbers. So that's something that gets a little bit trickier. But what is your take on downside reversals? Because on the flip side, sometimes you get the downside reversal, you expect more weakness, but that weakness doesn't really materialize. And I feel like that's what we just had in this most recent example.
Yeah. And you and I yesterday, we were doing a bunch of work on these and looking at a lot of historical examples. In fact, every single historical example between yesterday and today of these downside reversals. And I think there's a lot. Say again?
64 of them.
All 64, yeah. And they were, it was very eye-opening to look at all of them again for the first time in, over a decade when we originally did this. I think there's more work for the two of us to do on this to change our definitions of what a downside reversal is, a lot to do with the spread. And like you said, it's one of those things, it when you see it, and not all of them match our current definition. So that's something we'll work on. And if we come up with something good, we will share those results with you. But I think you were going to share all those ones that we.
Yeah, so I'm going to just share real quick the 64 that we were looking at. And again, we want to do more work on this because as we were looking at some of these, they were like, oh, why didn't it capture this one? Oh, it wasn't at a 13-week high. Oh, why didn't it capture this one? Oh, the spread wasn't high enough. And we're like, oh, it really should have caught that one. So there are a number of these that this was actually our last kind of visit to the downside reversals was 10 years ago. Yeah, it was in February of 2014. I was looking at the notes. That's the last time we had done.
You want to date us, is what you do.
Right? Exactly.
You want to make us look as old as possible.
So yeah, it was 10 years ago. The last time we were kind of looking at this, and we have we only had 50 downside reversals at the time. So we've got another 10. There's more data points to look at, and let's face it, you and I have 10 more years of experience too. Yeah. So we hope to put some of that to bear. But let's go ahead and I'll bring this down real quick, and I'm gonna go back to the market surge chart. And what I'm gonna do is I'm gonna go ahead and pull that up, and we're gonna change the date and look at some of the examples. And gosh,
can we start off with the current, just so everyone?
Okay, yeah, just to orient everyone.
Yeah,
sure. So what do you want to look at?
Let's just look
at the most recent ones, because we had a lot of them recently. We had this one here that was very recent. Back here on March 8th, this was a very classic one. And in fact,
started with NVIDIA, right?
So let's just take a look real quick at NVIDIA. And I do have a small position in NVIDIA.
Me too.
I was going to add to it today, but
I did add a little today.
Yeah, I just got busy. A short day, ran out of time. But I had done a lot of selling of a large position. But that was the reversal on NVIDIA. You can get these downside reversals with stocks and markets, and that was the base, and it didn't do anything for a while.
And let's just pause there for a second with the NVIDIA. That is kind of normal with the downside reversals happen on stocks, ETFs, indexes. that's more normal of what you think of with a major downside reversal. Like that wasn't just just barely making it through the rules. Like that was an outside day, meaning your
Yeah.
high was higher than your prior day, low is lower than your prior day's low. You closed underneath it. Like that was, it stands out. Everyone and their brother sees that. And it just didn't mean the stock was done. It just needed to base out, spend some time. And that's kind of the concept of the downside reversals. They come in different shapes and sizes, but it's basically like you run out of gas and you need to come down. And we had that one here recently, a week and a half ago on NVIDIA. And what happened? That's kind of normal. You have a big downside reversal and you have 2 to 3 days of pain. Historically, right. That's what I've always thought of. Now, as we went through some of these current examples or more examples, we're seeing that that's not always the case. So we can go back to the NASDAQ.
Okay, so we'll go back to the NASDAQ. And again, just to kind of reiterate some of the ones that were more recent. Of course, we had the one from last Friday, that March 8th. That one really sticks out. We actually had one here on May 23rd that qualified as well. And even going back here to December, I think this was one right here too. Yeah, there have been a number just in the last year. In fact, it was interesting as we were looking. Again, we just in the last 4 years, we kind of separated things by decade, and just in the last 4 years, we've gotten 15. So it was kind of interesting that we had so many, so recently. So you want to go back in time?
Yeah, let's go back in time.
Okay, so we're going to use the change date feature. Again, if you're not using the change date feature on Market Surge, you're kind of doing yourself a disservice, because there's so many great things you can learn by studying history. And this is how we come up with precedents. Now, I'm going to date us again. You and I remember trading, this time period.
It was
long-term capital management. Actually, this is kind of when I first started out. I remember this follow-through day. Things were looking really bad. It was Alan Greenspan, the maestro, had to basically come in and step in and say, okay, long-term capital management is enough of a risk to the whole economic system that we're going to have to do a bailout here. And things got uglier. You also had Russian defaulting on their currency. You had what was called the Asian contagion, with a bunch of Indonesia, and a number of currencies in Southeast Asia that were running into some real trouble. So yeah, it was pretty widespread. But during this time,
that was brutal. Maybe change the date to December of '98 so people can. That, by memory, was a 33% bear market that we went through. So it doesn't look
very
like
quickly.
Yeah, you can see how the change date is so important to always change it, because the scaling then reflects what it would have looked like at that time. And that was violent. I mean, that was really bad.
And now one of the things that started with was a downside reversal. This is, again, that kind of classic example where you're coming up. It was a 13-week high. You're trying to get into new high ground, and then you get into new high territory, but then you can't hold it. And this was a pretty dramatic day of a drop. It was down 1.74% for the day, closing at the very bottom of its range. Definitely an outside day, but not just an outside day. This was engulfing 3 days, basically, of price action. So pretty classic in that regard.
Oh, it was absolutely classic. And that's why when you have these, you want to take action, because if you don't and you wait and you go, okay, I'm just going to wait the storm out, this can happen. So it kind of goes back to the old analogy that Bill would always talk about with, selling, having a stop loss, whether it's 3% or he would use 7 to 8%. You have that there is an insurance policy in case things get really ugly. So with a downside reversal, you need to take some action because sometimes it's going to end up like this. Now we saw recently, like we had this week, it didn't work out like this, but that's just that insurance policy. You put a hedges on, you raise cash, you adjust, assuming you're going to have some sort of a fall. Doesn't mean you're going to have a 33% bear market every time you have a downside reversal. But I like how you noted all those other downside reversals in there that didn't qualify under our rules because one rule was it had to be a 13-week high. Clearly, those weren't 13-week highs, but those were all in the spirit of a downside reversal. And that first mark that you have there, where it comes up to the 18,700, that was right up against a moving average. In this case, a 50-day moving average. So when you have a downside reversal that's coming up to a moving average, it means even more, as we saw in this case.
And actually, all of these cases were really kind of close to moving averages.
Yep. And then that one was close to the 200-day as well, which is even more important than your 50-day.
Mm-hmm. And then here in October, so this was, just to give some dates out, this was August 19th. Again, for those that are maybe listening to this, you can kind of go back, rewind this, and take a look at the video. August 19th, 1998. Then we had September 24th, 1998, September 28th, 1998. Then over here, October 20th. Now, at this point, we had the follow-through day. The follow-through day was right here, if I remember correctly. Actually, you know what? This actually might have qualified as the follow-through day, now that I think about it. It was enough there. But, it had a quick follow-up. And then on October 20th, another 50-day moving average line reached up there and then turned around. And then another one almost to the 200-day moving average line before turning around.
And I think the important thing about those last two wasn't what happened on the downside reversal, is what happened afterwards, just like this current week, where that's a tell that if you're a poker player, you're looking for tells. That's what you're doing with this, is you have the downside reversal, which means you should have further weakness, sometimes more than others. But if you immediately go back up, it tells you the buyers are still, the bulls are in control. And if you could push it through the high of the downside reversal and actually close above that right away, the bulls are still in control at that point. And that's what we saw there. Both of them had the downside reversal buyback, which is a rule that the three of us came up with during market school, that was actually a buy signal on each one of those. If those were qualifying downside reversals, which they weren't because they weren't at 13-week highs, but it's still in the same spirit, right?
Mm-hmm.
Of they certainly look like downside reversals.
Right. And then we very quickly got to more downside reversals here on 11/11/1998, and then also here at 11/30/1998, a pretty dramatic day right there. So we're going to jump forward a little bit and look at a couple more of these. So we have we'll pull the screen back up, and we've got the November 11th right here, 98. And then this was a pretty dramatic day right here, the November 30th, 98. And then a little bit higher up, January 12th. And again, remember, because I moved forward in time a little bit, and because we had more price action up here, that does squish the chart a little bit. So that's why we like to go back to as close to the day as possible, because it kind of gives you a sense of what you were looking at the time. So Mike, let's talk about some of these days. The reality is, again, these first days in October didn't count because we didn't have a 13-week high. Mm-hmm. We did here in November 11th and 30th and January, but the market just kept on going up. So it wasn't really stopping things. So how do you know when a downside reversal is not something to worry about?
Well, unfortunately, until we finish our research that the two of us are going to do together, we don't know really until you're back above the high of the downside reversal. There are clues like that upside reversal that you had after that second one there in the November timeframe, you do have to remember that on that downside reversal, the next day you did get weaker. Same thing
Hmm.
with the other one, even though you closed well off the lows on the one there in January at the, intraday, you were all the way down to your 21 day. So
Yeah.
that was more normal action. And so I would say in general, as a starting point that the two of us are going to do is a 50% retracement, meaning from the high of your downside reversal to wherever your low is, you expect further weakness until you start trading above the midpoint of that. Now, of course, we do have examples where you get up even close to your old high and then roll over. But for now, what I would say is once you retrace at least 50% of that, then you might want to back off of some of your hedges or start tapping, putting that gas back on a little bit. But you don't really know you're out of the woods until you close back above that, or even better yet, your low is above your downside reversal, the high of it. And so there's this balancing thing, right? If you wait that long, you're going to miss out on a ton. And so you have to just kind of do it gradual, like we always talk about. It doesn't have to be an all or nothing. Is the closer you get up to those old highs, then you start putting on the gas more. Once you start surpassing it, you can kind of feel that you're out of the woods. But we have some other examples we'll look at that are even trickier.
Yeah, just one more thing on this, because this was a case where we were fairly early in a new bull market. We'd just come off of a 30% plus correction, and so is there a kind of a difference when you've been moving for a long time, you've been really kind of extended for a while, and you get a downside reversal versus a little bit earlier in the move? Because again, in this case, we saw how we just kept on shaking off the downside reversal and continuing to highs.
Well, we still need to study that, but just as a general thought, some of my other work that I've done separately with the Webby RSI early on in a new bull market, you tend to have a lot of power and a lot of things that get overbought. And so when we were talking about the Webby RSI with the 0.5 to 2 is your normal ATRs of your low versus your 21 day, that at the very beginning of a new move, you end up getting up to 3, sometimes even 4 ATRs because you have this power. So when you were in that situation, having downside reversals, other bad breaks and things that quickly move higher are normal because the market has just gotten ahead of itself, needs to have a little corrective phase, and can bounce back. So I think that's the case, but the two of us will just go through and study it and see. And that's how Bill taught both of us, is you have an idea and then you go with an open mind to the data and see if that's accurate or not.
Mm-hmm. Let's go ahead and go forward a little bit more. This is 2007, and this was a pretty short rally. I remember that, for a lot of folks, there wasn't much progress made for most of the year. It was a lot of back and forth action until the end of the year, and this was a really powerful rally. You had, the shippers like Diana Shipping. You had First Solar, Sun Power. Crocs, VMware had just IPO'd. There were a lot of stocks that were really very powerful in here. And I remember
China stocks were going at that point too, if I'm not mistaken.
the what?
I think some China stocks were moving pretty aggressively during that time frame.
Yeah,
too.
that's right. Well, and those were a little bit tricky too, because you had, like, right here, what was called the Shanghai surprise in February. Everything looked fine, and then you'd get that. Everything would look fine, and then you'd get something like that. But what I want to kind of pay attention to here is, as this rally was, again, that big thrust, you had this day right here, and it looked like, okay, weakness was coming in a big way, but then a couple weeks later, we popped into new high ground and then rolled over.
Yeah. So this action that happened after that major downside reversal that you've marked on there, that's normal. That's what you expect to happen of coming down, having some weakness, undercutting your 21 day like it did. Then you had your upside reversal, which was kind of your signal to get back in, and you should have gotten back in at that point. Now, afterwards, we know this was the beginning of that terrible 2007 to 2009 bear market. But in the moment, at that point, you have that upside reversal. You need to be pushing it hard up until really the day after that top day. That was your major expectation breaker that happened. And that was also a part of market school that the three of us came up with. That really based off of that day was the reason why we came up with that. So up until that point, you wanted to have that gas pedal slam down. There was a lot of money to be made during that time. It was afterwards you needed to adjust. So that's a long way of saying that downside reversal did exactly what you thought it should do. Is it brought in some selling, then the market firmed up, went up, and then of course the rest is history if you study the 07 to 09. The point that you should remember on these downside reversals is it's a lot like what Bill would talk about with distribution, that you have a lot of meaningful distribution that happens on the way up in a market. And so a lot of the distribution people don't notice because they just think of the distribution that happens after the top. It's really on the way up that he always talked about that was important. And you'll see that with a lot of these downside reversals. You have one, kind of reacts a little bit, can make it back up into new highs. You'll have another one that has another reaction. Then ultimately you roll over like what happened here.
And just as a reminder, a lot of times when it comes down, it can come down very fast. If you were a little bit slow to react, you very quickly found yourself back down at the, at the 200-day moving average line with a 10% correction in just a matter of a couple of weeks. So we got one more example here. We're going to fast forward to 2021. And just as a reminder, a lot of growth stocks really topped here in February 2021. It doesn't really show up here on the NASDAQ composite because we continued higher for the rest of the year. But, if you look at, for example, ARK-K, the ARK Innovation ETF, you can see that clearly topped in February, and things got pretty ugly in the more speculative names. For a while there, revenue was all you needed. You didn't really need earnings. And then all of a sudden, earnings mattered again. But getting back to the NASDAQ composite, in November here, that's where we saw a pretty dramatic and classic downside reversal here on November 21st.
Exactly. And again, pay a little bit when you go and study these, pay a little bit more attention to the ones that are more dramatic, like this one, meaning it really was an outside day of a few days, right? Because that day and the day before it almost undercut the 2 days, the low from 2 days before that. So it was very meaningful. That's a warning in the market. And again, it was right around a round number. That tends to happen. You've got a lot of people who kind of have price targets. It used to be a big thing with the Dow. When Dow would hit 10,000, people had baseball caps and things. It was like these big round numbers on indices have a psychological impact, and you got to believe a lot of people are shorting it around the round numbers or just taking profits. So it needed to rest there. And then this was what is normal to have happen after that is further weakness. You just never know how much weakness you're going to get.
Yeah. And in this case, it ended up getting a lot weaker as, 2022 unfolded. And yeah, it started getting a little bit uglier. And again, living under the 200-day moving average line. And I misspoke that this was actually not November 21st. It was November 22nd, that downside reversal. So for those of you that are going to be looking back at charts, a little bit later on. And then, again, we already kind of covered the current action, but just as a reminder, one of the things that you and I were doing as we were looking at those 64 examples, it was kind of interesting to note that how many really happened in the last 4 years. And a lot of the ones that happened in the last 4 years, that they kind of turned around and came back pretty quickly. You did have some weakness. I mean, just the downside reversal day itself is a weak day, but you know, a lot of times you were kind of getting back to highs fairly quickly, as we've seen here on the 28th, and you know, and the 23rd, and you know, a little bit less so, but on March 8th. And then, did you also want to take a look at what was it, June? These here back in June. There was this,
Exactly. I think there were two of them there that we were going to look at.
yeah. So this one, it didn't count under our current rules, June 16th, because the spread was too small. And so what I mean by that is the distance between the high and the low was not really sticking out here. So
Can
this
we
one
do a change
actually,
date to around July of there, just so it's not as compressed, so
oh yeah, good
folks
idea.
can see it?
So we'll move this to June, July 23.
Perfect.
And yeah, so here's that day right here in June. That was June 16th, 2023. Again, didn't qualify under the rules as they stand right now because of the spread, but this day on June 7th did qualify. And you can see the spread compared to recent activity was much larger. And so that one qualified.
Yeah, and so again, this is a reminder that unlike the one that was the start of the that you know the major leg down that we had the last example, that it's really what happens afterwards. And the next few days, are you able to just, is it just a blip? It's just an overreaction, people selling a bunch and running for the exit at the same time. Then all of a sudden, hey, the coast is clear. How do you know the coast is clear? The best way that we know is actually moving back above the high of the downside reversal. But the closer you get to that level, the more you're probably out of the woods. But as you go through, and I would really encourage everyone to go through and study as many of these examples as possible for the super hardcore, study all of them and put it, the change date on the actual day of the downside reversal so you don't see what happens, and then play through it one day at a time. That's how I did it, and it really puts you're able to put yourself in that mindset of, if I was in that market, how would I be reacting, without using the hindsight that so many folks use just on an unconscious level. When you're looking at a chart, you know what happens afterwards. You're like, oh,
Right.
it wasn't that bad. Well, that's because you know. So you have to be intellectually honest, which is a challenge for all of us whenever you're looking at charts. That and so it's easier to just do the change date on that without knowing what happens afterwards. So when you're doing your homework, I'd approach it that way.
Yeah. And just one more time, we're going to bring up that these are all of the downside reversals, all 64, which again, we may change the rules down the road here as we decide, okay, is it time to kind of take another look at these?
And I guarantee you we're changing the rules.
Yeah. After kind of kicking the tires on it a little bit, there was like a lot of, and this is the rabbit hole we always go down, right? We start looking at things and we just, oh, let's, what if we did this? And then it opens up a whole can of worms. And then before you know it, we're missing dinners with our wives and,
and you're sending emails at 3 a.m. and everything.
Right. Okay. Well, that's going to wrap it up for our downside reversals. When we come back, we're going to talk a little bit about some of the stocks that are on Webby's radar right now. Stay tuned. We'll be right back. And we're back on the Investing with IBD podcast. Justin Nielsen here, along with our special guest, Mike Webster, senior market strategist at IBD. And he's helping me out while Arusha is out working, doing all sorts of stuff the month of July here. But let's go ahead and get into some stocks.
I heard a rumor that Arusha heard I was coming back and he left the country.
Yeah, you know what? We Rochambeau'd. Okay, who's going to be the one that has to stay? Man the fort. Let's go ahead and talk about some stocks. And I do have a position in this one. This is CrowdStrike. Certainly this was this was a big winner for me. Starting from this follow through day back in November, and then Palo Alto earnings came and really kind of shook me. Now, Palo Alto looked a lot uglier on this earnings, but CrowdStrike recovered pretty quickly and had its own earnings and seemed like it was trying to right itself, but then formed this base, and now it's coming out again. So what do you think of CrowdStrike?
Yeah, well, I have a position in it as well, and I'm glad that you brought up the Pan W on there, because when Palo Alto did have that such terrible reaction, it really kind of killed this space for a while. And let's pull up IGV, which is generally the ETF that I think of with this area, and I do have a position in this as well in IGV, and this has been just terrible really since the Palo Alto earnings. And then here recently with that final gap down that you had near $76, then it kind of flushed everything out and then has been able to bounce back. And I really think that based on all the screening that I do and what stocks are making it through, it feels like the software space and security software is really where the money is starting to flow. Of course, all the money had been flowing into chips for a long time. And while this area was sitting out, now it feels like it's rotating back into it. So let's go look at CrowdStrike.
Well, and just real quick, because you brought up chips, and I do have a position in SMH, but this is another area that's been, it had this kind of base after the NVIDIA downside reversal. Look at us coming full circle. Had that base while NVIDIA was basing as well, and it's been holding at the 21-day moving average line.
Yeah, I got back into this space. Well, I still have my position in NVIDIA, but I just bought Soxel yesterday and added to some of that today, which is just essentially a leveraged version of the same SMH trade. And there are lots of, although NVIDIA might need some more time before it makes its way out of this, there are a lot of other stocks in the chips sector that are looking nice. Taiwan Semi looks good. ASML looks good. There are a bunch of them that look very constructive, like they want to move higher. And if enough of them move higher, they'll just probably bring NVIDIA with it. So we do have the potential there with both IGV and the SMH and the related stocks all move up. That would be a perfect case scenario. We don't know yet because IGV hasn't broken out to new highs and is kind of wedged up here from the lows, which typically when you have a wedge up from that, you could even start the wedge from the 76.10, that this entire time hasn't had a really nasty shakeout. And lots of times before something can move higher, you have a nasty shakeout in there. We'll see. Hopefully, since we're both in this space, that doesn't happen. But if it does, you're kind of expecting it and kind of looking at it as a positive thing if it can get support at your 21-day. So let's circle back to the crowd.
And even this, the closest thing to a shakeout was probably this day right here. And even that, barely filled in part of the gap up, from the day before. So I'm sorry, what did you want to look at?
Oh, let's just go back to crowd and let's go to the monthly on it. This is a technique that whenever I would go over charts with Bill, we would start off with the monthly chart. Even if it's something we were familiar with, we'd start with the monthly chart just to refresh our minds of what the stock has been capable of doing, what it hasn't been. And what you're looking for is a time in history where it was a leading stock. And you can tell that by the price action, but really you're focusing in on that relative strength line. And is that trading above its moving averages or not? And it certainly did for a long time. It had its big correction, and now it's been trading back above those moving averages, ever since that turn. And really the distance that RS line is from its moving averages has been getting stretched, just telling you how strong that stock is. Now we can talk.
Well, I was going to say, since we talked a little bit about software, you and I both really like the story behind ServiceNow, but neither one of us are in it. What is it that's bothering you about this right now?
Yeah, I don't like this base that it had. I would look at this as, and I like ServiceNow so much fundamentally. And let's go to the monthly for a second on this one. I mean, this has been a monster stock. And when it trends, it really trends nicely. So you have this huge prior uptrend and this giant cup with handle that it broke out of on a monthly. And then it moved up and it's kind of building what I would call like a shelf on top of that cup with handle. What's problematic is that RS line is, lagging a bit. It's back above its moving averages, but it's not as strong as you'd like it to be. Let's toggle over to the weekly for a second on this one. And let's scroll down on the earnings in the quarterly block to just show why we like this one so much. Those are your quarterly earnings, and on the right are your quarterly sales. Not only are they strong, they're stable. And that's something that you don't see very often. Stable earnings, with that 5 that you're marking on there. So that's a 1 to 99, with the lowest being the best there. So earnings stability of 5 is really just showing that how stable the earnings are. And you can tell that by that green line there. That's your earnings line, and how stable that is and growing. That's very rare, and why that monthly chart looks the way it does. Now, why I don't have...
It's also, I should just mention, so that earning stability of 5 is with an EPS growth rate of 32%. That's an annual growth rate. The fact that you can have that, that strong of growth for annually for that many years with that kind of stability, I mean, that's pretty good.
That's insane. Like, it really is. And that's why I keep gravitating back to this. But then I look at that base and it just bothers me. And I'll tell you why. So the way I'm looking at it is right now it's showing a consolidation, but it's really, to me, 2 bases. It's a flat base on the first part of the consolidation that then fell out of that flat base and then formed a double bottom. But the double bottom, instead of being above or next to the flat base, it's under it. And just historically, I've looked at enough bases and studied enough of them that's a weak position. So let's go over to the daily and see it a little bit clearer. Yeah, that's how I would draw the double bottom.
Yeah.
So let's go to the daily on this and just look for clues in there. So you had that big gap down at the bottom of the base, and then you just kind of drifted up. You didn't have this massive shooting power right up, and this feels very wedgy to me. So I'm waiting for it to resolve. I would love to see a pullback to the 21-day, which is that green line, which will kind of resolve that wedge. And what happens with a wedge and why we don't like it is you're not testing anybody. Everyone who has been buying since that gap down hasn't been tested. If they have a trailing stop, their stops haven't been hit. No one has had to go through any pain. And lots of times, not all the time, you'll have to have some pain before it moves higher. But I would, if you're looking at this as a double bottom, as I am, the pivot was the 784.33, the middle there. And when it got there, it didn't have power through that pivot. So that's what I don't like about it. But I love those fundamentals. So how I'm resolving this is playing in the space and starting off with IGV, which has a portion in ServiceNow. It also has a portion in CrowdStrike and a bunch of other ones. You should look at the list. I think it's around 100 to 120 different stocks that it's in. So it's pretty broad based, and they all seem to be moving in that general direction. So as soon as ServiceNow gives me an entry point, I'll be hopping in there. I'm hoping to have, in a perfect world, shake out with an upside reversal. But as Mick told us, you can't always get what you want. So we'll just, if it keeps going, I might just have to chase it a little bit with a little baby FOMO position in there. But let's go back to the just to the CrowdStrike just for a moment, and then we can go to our last stock. This one is much more constructive in that it's formed, and again, I have a position here that this little shelf that that is forming outside of this cup with handle that it broke out. So it's holding in tight. I think if it can make it through the 394.64, which is your high of this little shelf, that's where I would be adding to it. At that point, it should be a magnet to 400. But as always, we take it one day at a time.
Mm-hmm. Okay, let's go ahead and round this out with a look at Amazon. I do have a position in this. We have it on Swing Trader as actually we went over a full position on this. It's a 5/4. What are you seeing here, Mike?
Yeah, I have a position in it as well. Let's go to the monthly again, just as a point of reference. So this one has a tricky history. And if you go back, in time, you can see, it really fell back in '99 and then moved its way up. And on a monthly chart, it looks relatively stable. But trust me, if you go and study a daily chart along the way, this is not an easy stock to trade. It's really choppy historically, but it's been tightening up, which is telling you that it's more at equilibrium with the holders of it. Because for a long time, Amazon was really criticized because they weren't putting out earnings, because it was Jeff Bezos at that time when he was leading it. He was just playing the long game and saying, you know what, I don't have to have earnings right now. I'm just trying to build a moat around his retail business, and of course, the more important AWS area. So what I like about this is it's not just retail, and it's not just in kind of the AI space. It's in both, and everyone uses their product or services in one way or another, directly or indirectly. So let's go over to the weekly for a second.
Real quick, one thing I just want to mention on this is, you have to be aware when you say that, this has been a tricky one. You look at this overall uptrend and you say, what's the problem? What you have to be aware of is these time periods of where you're not really outperforming the S&P 500. And there have been some pretty long time periods of years where it just isn't outperforming, the S&P 500. And that has to be a concern for you, because why take the single stock risk if you're not going to get paid for that risk? So
and that's a famous thing that Chris Gessel, always tells us, when we're looking at things. And I think that that's the one most important thing that I picked up from him, is looking at that monthly chart and that RS line. And if it's sideways, like it was for there, you're taking on more risk because you have one stock instead of 500 stocks. And this one is more volatile than SPY historically. So you're taking on risk without the reward. That's not a good game plan. So you're waiting for those times where that RS line is trending back above its moving averages. And this has been a nice move that we've had here. And you can see that earnings recovery. So quite different than the ServiceNow. The ServiceNow was this steady earnings line. And this one,
we can't even calculate stability.
Exactly. So night and day. Let's go down to the quarterly numbers on this one. And you can see, like, wow, this is massive growth, but it's massive growth that's coming back. It's a turnaround play from its earnings, but the sales really aren't there. So you want to be aware of what you're dealing with. And so it's a lower quality from that standpoint than both CrowdStrike and ServiceNow. While we have this up, let's pull up Costco, because in a way, Costco is a good comparison for the retail aspect of it. And this one trades nicer. It's got that nicer earnings stability because they don't have the other aspects of it that cost a lot of money for Amazon. They basically, with Costco, the story there, it's all about the membership fees, and they just trying to get as many people in there to be loyal customers, and very low churn in both employees, which helps with their costs, as well as customers. And then scroll down to that earnings, quarterly earnings. And so while it's not spectacular in any way, shape, or form, they are steady. And so the street likes steady numbers, and that's why this trades a little bit more in a mellow way and is holding in tight here. So this is another one that I'm looking at in addition to, I don't own it yet, but looking to get into this one. Let's wrap back up on the Amazon real quick and go to the daily. So my thought process here is, when you get around round numbers like 100 or 200, that's something we picked up from Jesse Livermore, over 100 years ago. that he talked about, that the market tends to be a magnet to those round numbers, and then you typically surpass it, and then it becomes a floor. So that's what we're waiting for Amazon. It toyed around with 200 this week. We hope that it can get back above that and then make that a floor. And then this would be, my target on this is at least a 20% gain from this base, if not a lot bigger than that, just based on how it's traded historically. So what it also has going for it is it's big and liquid, so the institutions can get in and out of there, and you can get in and out of there easily as well. So this is one that I'm watching, and of course I've got Amazon deliveries at least once a week, if not multiple times, probably like you too.
Yeah. At this point, we actually had to get from Amazon a better box cutter to cut up all the boxes that were showing up. But anyway, hey, thanks Webby, for having such a good time, and going through all that research. It's always fun to do that. We kind of nerd out a little bit. I hope you have a great 4th of July. Hope everyone out there has a great 4th of July. Spend some time with the family. We have golf cart parades in our area and water balloons, flying. It becomes a little bit of a war zone. So hope everyone has fun out there. And thanks again for being here.
Thanks for having me.
Absolutely. That's going to wrap it up for this show. Don't forget, next week, we are going to have David Ryan, 3-time U.S. investing champion and former protege of William O'Neill, on the show. So that's going to be great. He's someone that is on our IBD live show every week, but shares a lot of insights, and it'll be good to hear from him with some.
That should be a fun show.
What's that?
Great info. That should be a fun show. Tons of great info from him.
Yeah. So I always have a soft spot for David Ryan, because when I first started at the paper back in September of 1997, in November, the first workshop I saw was Bill O'Neill and David Ryan, and it was just life-changing for me. So hope that is something that becomes life-changing for some of you out there. So hope you join us for that week. Thanks for joining us this time. We'll see you.